Hey guys, welcome back to the Hilton True Wealth Podcast. I'm Mark Miller, manager of the Hilton Family Office, and today we'll be discussing the different levels of wealth and why the rules change as you get wealthier. Did you know that half of Americans have less than a $200,000 net worth? But in contrast, the top 1% starts around 13 million. Now, that gap is not just money, it's completely different strategies, behaviors, and a totally different way of thinking about wealth. So today we're going to break down the 4 levels of wealth, and you'll kind of see possibly where you are, and more importantly, why most people get stuck moving between those levels and the mistakes that they make. So not everyone is actually playing the same game. I say all the time that life is about levels, and especially when it comes to wealth, whether you might be flying Frontier or now defunct Spirit Airlines, or whether you might be flying in a Gulfstream 600, let's say, around the world. But let me give you some numbers just to kind of frame everything to start off. The median household net worth is $192,000 in America. Now, we're just talking about America. If you're listening to this in a different country, this is just specifically American statistics. The top 10% starts around, say, $1 million to the $2 million range. And when you look at the top 1%, that starts, like I mentioned, around $13 million. So what's that breakdown? The bottom 50% has about $200,000 net worth. The mass affluent are about $200,000 to $1 million, and that represents about 30 to 40% of the population. Top 10% is more like 1 to 2 million, which I mentioned. And ultra wealthy is generally 25 million plus. Now, in the Hilton Family Office, we might consider that 50 or 100 million plus, but technically it's about 25 million plus. So 18% of households in the United States are actually millionaires, but only 4% ever reach 5 million plus in net worth. And then back to the statistics, the rare statistics, about 1 to 2% get to 10 million plus. So moving from, say, $100,000 in net worth to $1 million is tough. It's very hard. All the things that have to be put in place to get to that million, it takes a lot of time, and sometimes it can take 20 or 30 years to get there. But going from 1 million to, say, 10 million, it's a completely different game, and it generally happens a little bit faster, and I'll tell you why as we go through the podcast. So let's define the 4 levels. Level 1 is what we would call the foundation or the formation of your wealth. The foundation builders, you might say, is the people in that space. So again, that's about a total of 80% of the population, so that's the majority of America. So the median American sits about here, which I mentioned at about 192,000 in net worth. And where this wealth generally comes from is income. There's an emphasis on saving discipline, so setting money aside as much as possibly can. And the biggest piece of that net worth in this area, and also some other areas too, is home equity. And we'll talk about that piece here in a few minutes. So generally, what is the portfolio composition in that particular space? Heavy into real estate, which happens to be mostly the home, plus often a lot of cash because there's emergency reserves there in case something goes wrong. So there's usually very limited equities, bonds, commodities, things of that nature. So here's some of the biggest mistakes that are made in this particular area. One of the biggest things is overcomplicating investing, meaning they're kind of all over the place in this area. People are still learning and they're kind of jumping on from one investment to another. Generally, this area right here, which against the majority of investors, will only make a couple percent per year if they're lucky, and primarily because they just don't have a lot of experience, even though it might take a long time in this particular wealth level to get to, say, $1 million or $1.5 million or something like that net worth. Chasing returns instead of saving. Sometimes they're, again, jumping from investment to investment, and there's the primary focus here is how much am I going to get in returns? And that is almost everything. And that's not necessarily the right way to go about it, but that's kind of the characteristics of this particular wealth level. And then there's also a lifestyle inflation, meaning at that level, let's say a family income is $200,000 a year. Well, as soon as maybe an event happens that they get another $50,000 or a raise or something like that, they usually spend it immediately with what we call lifestyle creep, where they want a bigger car, a bigger house, all of that, and that sucks away from building their wealth. So at this level, the biggest message is behavior matters more than strategy. That tends to be kind of the modus operandi, so to speak. So we have to start moving away from that as we go to the next levels if we want to build wealth more efficiently. So now let's talk about level 2. And that's what we might call an emergence of wealth. And that might be from 1 million to 5 million in net worth. And that's that top 10% down to 3 or 4% of the population. And again, like I mentioned, I'll just mention it again. I know there's a lot of statistics here, but only about 4% of the people in our country ever reach that 5 million threshold. So what changes in this wealth level? Well, investment returns now matter a little bit more. I might say a lot more because it's more important. So getting solid returns and better returns over time, you start learning more, and then that kind of just comes naturally. Taxes begin to start hurting at this point too, because when you start getting that higher net worth level, it generally means maybe there's a higher income level and the household income might be $300,000, $400,000, $500,000 a year. And Uncle Sam is coming in and taking a big chunk of that, which is pulling away from the wealth. And then assets become fragmented. Now, what do I mean by that? Well, when you're at the 1 million net worth level, usually maybe there's not a lot of assets there. But at this level, there's more assets. So tends to be a lot more investment picking and a lot of investments that are there, a lot to manage, which can be, well, generally that's a minus, but it can be a plus depending on how that individual or that family is picking stocks and bonds. So what is the mix then in the portfolio? Well, there might be a little bit more emphasis on real estate, but that family home, especially if there was lifestyle creep early on where they got a bigger house or whatever, that house may still be a good percentage. The home equity there might be a big percentage of their wealth, but maybe they've branched out into other real estate, investment real estate, which is a good thing. Retirement accounts are generally larger, a bigger part of that. IRAs, 401ks. Then they're in equities, they're bonds. Maybe they've gotten some commodities, maybe some gold or silver. Maybe they've started venturing into crypto a little bit, things like that. So here's an important stat and kind of a thing that is important to think about. Many millionaires have a large percentage tied up in their home plus their retirement accounts. And the problem with both of those investments, they're highly illiquid. So we have to figure out ways that we can make those more liquid. And wealthier people tend to be able to utilize that equity, their retirement accounts, in a better way that allows for a little bit more flexibility, you might say. So, what are the main mistakes in this area? Well, often they're still investing like beginners, that they're on the retail side, they're kind of listening to all the things the retail brokers are saying and investment commercials they see, and they're with these retail firms they're doing the majority of their investing with. There's no tax coordination, so they're paying way more in taxes than they really need to. And they're treating accounts individually. Now, what do I mean by that? There's no cohesive plan. They just have a lot of different accounts, a lot of different investments in different places. So what's the big takeaway here? You're no longer just accumulating in this phase. Now you need to start optimizing when you hit these wealth levels. So level number 3, this is what we consider high net worth, and that's 5 million, anywhere from 5 million to say 25 million. So, and that's approximately about 1 to 3% of the population. So all of these, we're talking small percentages of the population. So what changes? And this is, I think, where it really hits home. First of all, taxes become by far their largest lifetime expense. So they have to be managed in some way. Then risk also become asymmetric. So risk becomes something that has to be managed. If it's not managed, it can wipe out the entire accumulation of that net worth. Portfolio complexity explodes generally. Now, it doesn't mean it should. For instance, and I've talked about this in other podcasts, that say $10 to $15 million range is when things really kind of start changing, in the sense that maybe people are transitioning from being a retail investor and now they need to move to be an institutional investor. So they have a complex portfolio. Now, we usually try to manage the portfolios and make it less complex, so it's easier, it's less stressful on them. So to get to this point, a lot of times we'll bring people on board that are in this wealth level, and they're very stressed. They don't know how to handle this. They don't know how to handle that. They have no idea what, say, institutional type of investing or how the smart money invest. Really, in this area, we're moving from growing their money to protecting and structuring wealth. So the distinction there is investing to now more of a total process and a strategy to build solid wealth. So here's the portfolio shift. So maybe there's more movement away from just raw equities to, say, businesses, or being able to direct or invest directly in, say, LLCs or individual businesses that people are operating or they may have access to. Less reliance on the primary residence. So that is huge. And the introduction of private investments, structured strategies. So wealthy households hold significantly more, say, stocks, business equity in general. So they're seeking those things out. So what are the big mistakes here? Well, there can be often no coordination or not good coordination between the CPA, an advisor, an attorney, an insurance person, overexposure to different market cycles, or doubling up on exposure in the portfolio. That's a huge thing. And then extreme tax inefficiency. And again, because of that transition from, they may have accumulated a lot over time, over a 20 or 30 year period of time, but now they just don't quite know how to manage it all and keep control of it. So at this level, mistakes don't slow you down. They can erase you if it's not done properly. And we have seen that in the past. Now, not in our firm, but people that have come to us that have lost, say, 5 million, 10 million of their net worth because they got to a level and they just didn't quite understand how important it was to restructure things. Okay. And then level 4 is the ultra wealthy, 25 million, 50 million plus. That's only about a quarter of a percent to 0.5% of the entire population. So the reality is the top percent, 1% alone, controls over 30% of the total wealth in our country. And that's kind of staggering when you think of that. The numbers are pretty big. But their wealth tends to be pretty concentrated too. Maybe it's one business or two businesses, or maybe it's just one big piece of real estate, something like that. So what matters now more than anything? Again, tax minimization is huge. Estate and transfer strategies, so exit strategies in their business, succession planning, family governments, direct investing, control, building legacy too. So the mindset shift here is really from how do I grow it to now how do I keep it and pass it on efficiently and build this legacy. So the primary mistakes here are really no estate plan or a disjointed estate plan where you've got pieces over here, pieces over there. The family's not all together. There's been no communication in the family about the levels of wealth, poor generational education, overexposure to single risks. So there's a lot of risk here. And kind of the bottom line here and the key takeaway is wealth at this level isn't built. It's now managed. It's now transferred, and just a totally different level of processes, strategies. So by the way, if you're liking what you're hearing so far today, please subscribe, give us a quick thumbs up, a like, a comment. It will help us greatly. We really appreciate it. So most people are misaligned in their wealth levels. And I don't know where you fall in the levels I've talked about, but the real problem is that misalignment. They're not doing the proper things in that particular wealth level. So here's a great example. So a $3 million investor is using a $100,000 investor strategy. An $8 million household has zero tax planning. They're just the biggest expense of their life. They're just overpaying on taxes every single year. The $15 million portfolio has zero coordination amongst different advisors, or it's a poorly diversified portfolio. So really big insight here is that most people don't fail because they don't earn enough. They fail because they never change their strategy as they grow, as they get higher levels of net worth. So let me make this super clear and kind of the real transitions here. What changes as you move up in the levels? Well, if we look at these different areas, let's first talk about the level of focus. In level 1, and this is just kind of talking about some of the things I've already talked about, but just making it very clear. In level 1, most of the focus is just on income, trying to make more income, get more cash flow, and that type of thing. Level 2 is efficiency, becoming more efficient in the portfolio, more efficient in design. Level 3 is now focusing on protection, and I've talked about this in other podcasts. Wealthy people tend to focus more on safety and security than they do returns because the returns are just going to be there. And then level 4 is legacy. So that's the different levels of focus. When you talk about risk, level 1, can you recover? So you're kind of on the edge. Do I have enough cash in case an emergency happens? Am I going to get wiped out there? Level 2, I need to manage risk more and be better about it and understand the different risk levels. Level 3 then under risk is I want to try to avoid it as much as I possibly can. And level 4 is completely eliminating the level of risk. The next area is taxes. So level 1, it's kind of minor. Maybe you're not making that much, you don't have a huge net worth, and it's not as big a deal. Level 2, though, it becomes noticeable, and it starts to hurt your portfolio and ultimately your net worth. And level 3, it's a major drag when you get to that level. I mean, you've got to do something about the taxes, or else you're just throwing wealth out the window. And level 4, it becomes a strategic weapon to leverage, to build that legacy even more. What about strategy? What about that area? So level 1, it's pretty darn simple. There isn't a whole lot of strategy at all. Now, there should be a little bit more. And if you're in that area, you need to have some coordination and some strategy there. So level 2, you're more intentional about it. You're starting to say, hey, I've got to put a process together, a strategy that's going to work for me. Level 3 is we start engineering a strategy and processes to where they are very specific, very organized. And finally, level 4, this is on another level, the ultra high net worth. It's on a high-end institutional level. And then finally, when it comes to the area of assets, again, level 1 is more, most of the wealth is in the home. Maybe you got cash. Wealth and assets start to become, on level 2, more about the markets, stock market, bond market, commodities, things like that. Level 3, we start to become more diversified with assets. And level 4 is looking at private, direct assets, alternative assets. Now, one of the things that I wanted to mention was Brad Hilton and I's passion was kind of taking some of these level 3 and level 4 type of strategies and bringing them down to level 1 and level 2. So we can start to put more structure, especially in level 2 for the most part. And that's people that maybe have, 1 million to 5 million to 10, maybe even 15 million, to where we can bring all of these advanced smart money strategies and help you build wealth a lot more efficiently. So a key line is here, the strategy that built your first million is the exact thing that will cap your next 10 million. Okay, so let me explain that. Again, I go back to the fact that if you're doing the same things you did when you have 5 million or 8 million that you did when you had 1 million, you're going to be incredibly inefficient and it's going to be incredibly slow. So going up that wealth ladder, it's about start putting strategies and things in place to where now it's so efficient that you're building your wealth a lot faster and a lot better. Okay. So kind of wrapping it up and bringing it all home, wealth isn't, and I know I've given a lot of numbers here, but it really isn't about hitting a number. When we've done and we launched the True Wealth podcast, my idea was that it isn't about just amassing a chunk of money, even though I gave you these specific numbers, and they're great to hear and interesting, but it's about designing a life and using your wealth at those different levels most efficiently and taking the maximum amount of stress and pressure off of yourself so you can live your life, so you can enjoy your life. And that balance is super, super important. And you have to evolve. You've got to evolve your strategies as your situation changes. If you don't, then it can be very detrimental and, like I mentioned, very stressful, and you'll lose sleep at night. And that's the last thing that we want to happen with any of our clients. So at True Wealth, the conversation isn't, hey, what should I invest in? And this is a key point. And often when people come to us and they've been used to investing on the retail side, they're like, show me your investments. I want to pick which investment I like. That's not how the wealthy invest. It's more of when you get to these levels, it's what level are you operating at and what is your best strategy in that level to build and to move forward. You know, wealth is tiered and everybody is at certain levels. It's not linear, and I don't think it should be linear because it's like anything in life, you don't want to stagnate, hopefully. You want to continue to learn, you want to continue to grow. Well, wealth is no different. And most people, though, plateau at certain wealth levels because they've never evolved. And, generally, it's because they don't know how to do that. And maybe they don't have access to do that. But everyone is striving. Again, we're all at different levels, but the key is just keep striving, keep working towards your goals, and you'll get there eventually with time, patience, and just making sure that you have the right strategies in place. So that brings us to the end of today's episode of Hilton True Wealth. If you want to learn more about the topics relating to building your wealth, tax planning, cutting-edge tech, and family office services, we're here to help in any way that we can. Be sure to follow us wherever you get your podcasts so you never miss an episode, and give us a like or a review below. And if you're curious to learn more about your wealth, tune in every Tuesday for new insights, special guests. If you found value in what you heard today, share it with someone that might benefit too. For more insights and resources and to get a free copy of our book, Hilton Wealth, How to Invest Like an American Dynasty, visit us at hiltonwealth.com. Thanks for joining us. Until next time, keep learning, keep growing, and keep building your true wealth.